Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com. Hi, listeners. I have some exciting news for you. I'm hosting the virtual Invest Smart Summit on June 6th. We'll cover how to more effectively evaluate sponsors, markets, and deals. We'll have one of the nation's top tax advisors, Tom Wheelwright, speak. And wealth isn't only about money. We'll also have Sahil Bloom, the New York Times bestselling author of The 5 Types of Wealth, and the acclaimed thought leader and life strategist, Tim Storey, join us. This is an event you won't want to miss. Go to investsmartsummit.com right now so that you can live your best life. Today on the podcast, we have Daniel Casey. Daniel is the president and CEO of North40 Capital, as well as BlackRock Construction Group. He property manages all of his properties and is focused on affordable housing. Daniel, thanks for coming on. Please tell the listeners a little bit more about yourself and what you do.
Yeah. So as Gary said, I'm Daniel. I'm up here in Tacoma, Washington. We've got, I've been a contractor for close to 25 years. And in that time, we've done a little of everything from highway and bridge construction work to general building construction, and then ultimately got specialized kind of in multifamily renovation. We started buying apartments 2018, I guess, was the first time we bought anything with a real investment intention. And since then, we've grown from an initial 8-unit building to now we have 400 units that we own and manage here in Tacoma. In addition to that, we have a couple of other real estate things. We have an office building, some industrial property, and a small hotel. But the apartments are our primary focus. Beyond investing and doing construction and development work, I've got a wife. We just celebrated our 25th anniversary last year, and I've got 3 kids, 13, 16, and just about 21. And we live on a small farm. My wife is very big into her farm animals. We actually just picked up, this year's crop of bees today. So that's a little bit about me.
Very cool. And congrats on your 25th anniversary.
Yeah, thank you.
So having a GC background really gives you a leg up on the competition when it comes to buying properties. You talk about that experience, how it's helped you and everything.
Yeah, so it is a huge advantage. I think that for most investors going into, especially when you're talking about large scale value add projects or anything that looks like redevelopment, probably the single biggest risk is that relationship with your general contractor. I mean, just the nature of the relationship is your interests aren't fully aligned. As a general contractor, you're trying to look for opportunities to make money, and you're trying to turn potential problems into extra work and things like that. Whereas obviously as an owner, you're looking for the most economic way to achieve whatever the desired outcome is. And so that was actually, doing work as a contractor for owners of investment property is really what turned us on to the idea of buying investment property. It was kind of after doing a handful of different projects and sort of seeing some of the economics on the backside of it. It really opened our eyes to the idea that we should be the owner and not the contractor. But that's how we got into the world of investment real estate, and it's definitely an advantage.
Nice. And what you guys don't chase deals all over the country. You go a mile deep, as you said, and focusing on Tacoma, but a few different asset classes. Talk about that choice, and I know it's more of a focus on affordable housing, but navigating all those different asset classes.
Yeah. So when we started, we didn't really pick Tacoma with any intention. I mean, we just happened to live here. So, that first property we bought just happened to be in our hometown. And so there was it wasn't like we looked at all the markets in the world and chose this one. But, Tacoma, like a lot of other markets, has its uniquenesses. And so we've just chosen to, to stick, to invest here and to stick here. we like the model of being an owner operator. I think that there's a lot of value in being able to control the entire housing product, not just the physical space, but the management and the services and, kind of the entire aspect of it. And so that's just been the way we've chosen to operate. Affordable housing is something that we're interested in. We actually don't own a ton of quote unquote affordable housing today. We own a single property that's a designated LIHTC property. It's only 34 units, but the truth is we didn't buy that one, to keep it affordable. We bought it because the LURA expires at the end of this year. So we really bought it in kind of a traditional value add mindset, just looking at the idea that we could convert it to market rate. But, since then, I've looked a lot at just kind of the landscape of multifamily housing, especially in a deep blue state like Washington. And I've kind of come to the conclusion that at the end of the day, at some point in the future, all multifamily housing providers in Washington are going to be affordable housing providers. And so rather than sort of fighting the current and, fighting to somehow be the last market rate developer standing, like what if we were to just go the opposite direction and embrace it? And what if we became the best affordable housing provider before everybody else finally, gives it up and gets swimming the other direction? So, we're pursuing some opportunities now. We don't have anything currently in our portfolio that's kind of true affordable housing.
I truly believe that there's opportunity in any market, depending upon how you underwrite and whatnot. And yeah, sticking to where you live and making that your kind of thesis and monitoring what the different opportunities are out there, I think is a great way, and getting ahead of the affordable housing, because yes, they have to come up with a solution. Red states, blue states, because they're only building Class A typically, which that's what only pencils, and so you're losing B product and Class C product every year. And so it's a real battle to find, of housing for the workers versus, in LA, they might need to live 45 minutes out, an hour and a half out to come travel to work, and drive all the way back home, which is it's a huge struggle. So how do you foresee yourself getting ahead of the game? What are you doing now to be that main, company to go as a go-to?
Well, I think one of the biggest differences with affordable housing versus market rate development is the sources of capital. So in a market, as a market rate developer, you're primarily going out and getting some sort of conventional bank financing, and then you're bringing in some sort of equity, and that equity is typically looking for market rate returns. It probably varies across the board, but generally speaking, we all kind of understand how the world works in kind of market rate housing. Affordable housing is different because you've got a few other players in it, and the incentives are a little different. So you don't start with kind of traditional bank debt. You start with kind of preferred terms, agency debt, which kind of gets you're starting off with higher leverage, lower cost, and kind of a little bit more favorable, kind of foundation to your capital stack. But then there's a number of other, things that you can, add in there. There's, public and private agencies that have different types of subsidies, whether they be grants or loans. In Seattle specifically, Amazon has dedicated a lot of resources to affordable housing. So I don't know if you've seen any of the stuff they put out for their housing equity fund, but I think to date they've got $3.5 billion that they've allocated in this housing equity fund, specifically to affordable housing in Seattle, Nashville, and the DC area. Those are kind of Amazon's three main hubs. So, that's kind of just one particular opportunity, but that's something we're looking at specifically here because we're obviously, just outside of Seattle. And so I think, so the numbers are just very different. Like when your capital is highly subsidized, you don't need the same returns to essentially return the same amount to what your equity ends up looking like. So on a traditional market rate deal, you might go into it with, 35% of your capital stack being some form of equity. And on a market rate deal, you might go into it with, 10 or maybe 15% of your capital stack being some form of equity. And so obviously to get that equity, the returns they're looking for, is kind of very different from an economic standpoint on the whole project.
So in 2018, you bought your first 8 unit and have since grown it to 400. I think there's a lot of people that a lot of listeners that are trying to grow the portfolio and aren't, they aren't huge on social media and whatnot. So how did you, build your portfolio over time with investors or whatever mechanism you used?
Yeah. So in the beginning, we started out like that first 8-unit building we bought with all of our own money. This was just kind of a little bit of capital that we had from the construction company. And so we took out a hard money loan and did the first deal really conventionally. And then we bought a couple of other deals similar to that. I think we went from an 8-unit to a 12-unit. And then we ended up buying a 10-unit that was owner financed. So this was still just kind of rolling our own equity as we were essentially burying these first few projects. When we finished that first 8-unit and refinanced, we were able to get all of our capital back and then some, and we were able to roll it into these other projects. And so we did 8-unit, 12-unit, 10-unit, 30-unit, and the 10 and the 30 both involved a little piece of owner financing. And we were able to do all of that simply by burying the initial capital. And then after that, so that got us up to 60, I think it's 64 units, or 60 units, 62, whatever that adds up to. But and then we connected with somebody else who had a private equity fund. And so we did a handful of projects as a joint venture with them. So we've actually never raised kind of retail capital ourselves. Everything we've done has either been, kind of our own initial capital that we've, bird out of other projects, or it's been stuff we've done in a joint venture where somebody else was really doing the capital raising and we were just partnering for the operations. But that's, that kind of gets us to where we're at. We've sold a couple of things here and there, we actually sold that original 8-unit that we built. We sold that last year, just to, kind of harvest the equity out of it and use it for other things. But yeah, that's how we've done it.
And also some of those smaller deals too. I mean, you have a much higher expense ratio and stuff like that. So getting, if you can move into bigger properties, it definitely helps. Easier to manage. You get better staff, stuff like that. So that definitely advantages too as you kind of scale up. But it's great that you partnered with someone that was able to bring the capital so you could focus on what you guys do really well. I think a lot of people out there struggle with, trying to balance everything and having, letting someone just rely on that frees you up to find the right properties, manage them and whatnot.
Yeah, no, that for sure. And in the beginning, we really didn't have much of an investment thesis. We were really just looking for deals. So I would say that those probably the first 3 or 4 deals we bought were simply, anything that looked like we could make a few bucks. And then as we got a little bit more experienced and we sort of started to, just to learn more, we really started to focus on a particular niche in the market. And so now when we're looking at buying property in Tacoma, we're really looking at like 4 or 5 zip codes. Like we're not just like broadly interested in the whole, county. And so, and it just makes a big difference. Like you said, you kind of focus, you sort of focus on the things you do well. In our case, we serve a particular segment of the market in a particular, a fairly tight geographic area. We're looking for a particular vintage of assets that need, that kind of need a certain scope of construction work. And so we've got it pretty dialed in where I can tell pretty quickly if it's when we're looking at an opportunity, we can tell pretty quickly if this is something that fits, our buy box or not.
So what is that buy box? Why those 4 zip codes? What vintage? What are you looking for?
So for the most part, what we're looking for is kind of 70s, 80s build, garden style in what would be A+ neighborhoods for Tacoma. So this is North Tacoma. So for anybody who's listening who happens to know this area, we're talking downtown Stadium, Ruston, North Tacoma, University Place, Fircrest. It's kind of the already gentrified premium downtown adjacent neighborhoods in Tacoma. And so these are neighborhoods where there's absolutely no vacant land. These are very densely developed, and all the new development that's going in is kind of podium style, Class A apartments. So we don't have to, in these neighborhoods, we don't have to worry about anybody coming in and building new Class A garden style down the street. And so what we're looking for is typically, like I said, 70s, 80s vintage garden style, ideally something that hasn't been, partially renovated, I guess. Like what we don't want is somebody who did a renovation 4 years ago at a lower standard than we would do it. And now we're paying for things that we're going to end up tearing out. So we're ideally looking for somebody who hasn't touched this since, the early 90s or something like that. And then we do a full scale, renovation, probably bordering on redevelopment. We do a lot of exterior work. So we'll do major landscape improvements. We'll do parking improvements. We'll really try to create kind of a B+ garden style product that we can use to compete directly against that Class A podium style stuff that's being built just across the streets.
So you're looking, what's your rent bumps on the work you're doing, and how much money are you putting in, and what's the difference between the rents for the Class A?
Yeah, so that's definitely changed over the last couple of years. So I can tell you where it was a couple of years ago and where it is today. So when we really started doing this strategy, we were getting huge rent bumps in these, for this space. So like, for example, a 2-bedroom apartment, we might buy it in a situation where it was getting $1,100 or $1,200 a month in rent. We're doing very premium renovations that are probably in the neighborhood of $38,000 a unit, but we're getting, $1,995 to $2,195 on the back end. So we're getting almost $1,000 a month per unit in rent escalation. That's where we were when we were starting doing this. And now 2 years later, we're finding that there's not nearly the premium being paid for kind of luxury amenities. A lot of people are still attracted to the idea of, a fancy renovation with, in-unit washers and dryers and all that kind of stuff. But then when they're given the opportunity to take a legacy unit right next door that's $300 or $400 less, it seems like most tenants are willing to save the $300 or $400 and, walk down the hall to do their laundry. So so we're still doing those kind of premium renovations, but what we've adapted to is we're typically doing them at a couple different levels. So if we were to go buy a building today, probably our base strategy would be to renovate maybe a quarter of the units to that sort of premium level, and then renovate maybe half the units to some kind of hybrid where we kind of put in a couple of the flares of the premium unit, but largely leave, most of the expensive things untouched. And then we would probably leave a percentage of the units more or less as is, just freshen them up with some paint, and then kind of present people with, a fully renovated, a partially renovated, or a legacy is kind of how we refer to them. And, I feel like that unit mix these days kind of maximizes revenue and minimizes our development cost.
Yeah, for us, and typically we buy in Tucson, and we could sometimes get $200-$300 rent bumps on, $6,000 to $12,000 renovation. And the last 2 years, we just, for the most part, haven't been getting it. The price sensitivity has been, nothing I've seen before. Now we're, on some properties we're doing those renovations, but it's still, working through. I would say a lot less rent growth these days. But I think, as there's a lot more get through that new inventory, then we'll be able to get those, bigger rent bumps too in the next, 6, 12, 18 months.
Yeah. I feel like this is we're going to be well positioned in the next couple of years. I think that when we take these properties on now and we're doing a few units at the higher level renovations and kind of keeping the rest of them all in a more mid-grade, it'll give us that opportunity to kind of prove those rents in those, upscale units. And so when there is an appetite for them again, we'll be in a good spot to, potentially get another round of financing and go and do the rest of the renovations or whatever. I think there's some benefit to that, kind of the proven, having some proven rents that you can like base a phase 2 or a phase 3 off of. Yeah.
Or sell the dream of the value add to someone else.
Yeah. It's the meat on the bone, right? There's you almost never maximize value at a absolutely fully stabilized, property. So yeah.
So are you in big buy mode right now, or are you cautiously kind of surveying what's out there? Where are you guys?
So we're definitely in buy mode more now than we were last year. So last year, I felt if I was going to put a theme on the year, I would say 2024 was all about getting our house in order, getting our operations dialed in. I think we to some degree, 21 and 22 were such easy operating environments that, we were probably a little sloppy and we grew faster than our systems. And so, as we got into the beginning of 2024, I think we realized, gosh, we really need to get this stuff dialed in. The market's not helping us. In fact, in our area, rents were moving away from us. Collections were still not recovered from COVID. There was no more assistance paying people's rents. And so all of a sudden, we realized we really needed to get this stuff figured out. So we spent we acquired a couple small things in 2024, but nothing significant. But then 2025, we feel like we've got everything in pretty good order, and we've been more actively pursuing acquisitions. We've got one property under contract now. We've got a couple other offers out, and so we're definitely buying. What we are looking for, what we're kind of our buy box right now, at least for the Tacoma portfolio, is we're really looking for owner finance deals. It seems like we've successfully purchased a few things now where we're essentially offering to overpay people in today's values for highly favorable owner finance terms. And it seems like there are enough owners out there who've been frustrated by their lack of ability to sell, that if all of a sudden they think they can get out at a price that sounds reasonable to them, they're willing to offer favorable terms. So that's been we're really not pursuing anything that's kind of true market rate, like where we're going out and just getting conventional bank financing right now. Like everything we're doing in our Tacoma portfolio is some form, something unique, like either assumable debt or owner financing.
Yeah, I mean that's a great way to win deals, because the seller might have certain expectations on the price, and in order to get that price, he needs to give you something which is that assumable debt or really good terms on the financing, which it'll minimize his tax hit and have you lower payments over the course of a bunch of years.
Yeah, well, that's exactly because the typical avatar is somebody who's probably a little bit older and they're ready to be done, and they've been trying to get out for the last couple of years, but the market's moving away from them and they're starting to get frustrated. And so I think what we offer them is kind of the simple value proposition is like, hey, we can get you 2022's price if you can give us 2022's terms. And that's kind of how we can simply explain it to somebody. And so, in a couple of these situations, there's been people who've had properties on the market. Maybe they've been listed 2 or 3 times over the last couple of years. So we've seen sort of the price deterioration as they keep trying to go out, and they keep being unsuccessful. And so I think it just resonates with somebody who's just fed up. They're fed up with the process. They're sick of operating it. They want to retire, but they don't want to feel like they're selling at the bottom and taking a bath. So this gives them the opportunity to sell it at a price that they can feel good about, and yet still relieve themselves of their day-to-day operational responsibilities. And you said like they can defer the taxes and figure it out in a couple of years.
Well, I know last year, you put together an amazing summit. I was there. Talk about the summit that you're putting on in the next few months. Who are the speakers? What is it about? Where they can sign up?
Yeah, so it's the Gobundance Multifamily Summit. So Gobundance is a mastermind that Gary and I are both a part of, but this event is open to guests as well. But it's so it's going to be in Sundance, Utah. It's at the Sundance Resort, just outside of Salt Lake City, August 25th through the 27th. We've got a number of fairly big name known speakers. Benjamin Hardy is going to be headlining it. He's author of a number of books. I think most people in the personal development space are going to be familiar with his work. He's got a brand new book called The Science of Scaling that's going to be released in July. So he'll be there kind of immediately afterwards to teach some of the lessons from his book. Other well-known guys that are going to be speaking there is Jay Scott, Matt Faircloth, Andrew Cushman, Amanda Hahn is a CPA who's does a lot of work with a lot of big investors. Bethany LaFlamme is partner in Premier Law Group. They do a lot of syndication work with a lot of big investment groups, and there's a number of others. But basically, what this event is compared to maybe some of the other more popular multifamily events is this is a small, intimate setting. Probably 75% of the attendees are operators, 25% of the attendees are investors. but there's nothing for sale. Nobody's there to raise capital. Nobody's there to pitch deals. Everybody's there to basically learn from each other on how to become better operators, how to become better business owners. The investors in the room are looking to better understand the business of multifamily so they can, pick better operators and, be a more responsible LP. So, it's a little bit of a different flavor, I think, than most industry events people are used to, but it's a good time.
And where can people sign up for that?
So you go to the event has its website. It's multifamily2025.com. So really easy. That'll link you to the events website. And then from the events website, if you click on the register now, it'll link you to Gobundance's website, who's actually, where they actually collect the money. But multifamily2025.com. Like
I said, I definitely recommend it. It was just top notch, from the food to the networking to the speakers. So, unfortunately, I can't go this year, but I wish I could. But hope to go next year again. So,
we'll miss you, but hopefully we see you in 2026.
Yeah, absolutely. Well, thanks so much for coming on and sharing your experience and your journey. Please tell the listeners where they can find out more about your company.
We probably should have a little bit more of an online presence, but you can find our somewhat outdated website at North40Capital.com. You can also find me on Facebook, Daniel Casey, or on Instagram. I think I am the Daniel Casey on Instagram, and I'm also on LinkedIn, but I don't check it very much. But if you were to DM me that way, I think it'll send me an alert. But anyhow, thanks for having me, Gary.
Yeah, awesome. Thank you. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.